Assalamu alaikum. Welcome to Learn at Your Desk. Today, we are going to discuss basic theories of accounting. Before digging into a new lesson, let's recall the previous lesson, Introduction to Accounting. You can also find the link of the previous lesson in the description box below. Recap. As discussed in the previous lesson, accounting is concerned with recording, classifying, and summarizing of financial transactions, and interpreting the results thereof. It aims at providing information about the financial performance of a firm to its various users, such as owners, managers, employees, investors, creditors, suppliers, tax authorities, etc., and help them in taking important decisions. All these people look forward to accounting for appropriate, useful, and reliable information. For making the accounting information meaningful to its internal and external users, it is important that such information is reliable, as well as comparable. The comparability of information is required both to make inter-firm comparisons, that is to see how a firm has performed as compared to the other firms, as well as to make the inter-period comparison, that is to see how the firm has performed as compared to the previous year. This becomes possible only if the information provided by the financial statements is based on consistent accounting policies, principles, and practices, which we will learn today in this lesson, Basic Theories of Accounting. Before we begin, let's see what we are going to learn in this lesson. Overview. In this lesson, we are going to focus on the following topics. First, we will learn what is meant by GAAP, basic accounting concepts, accounting standards, IFRS as global standards, basis of accounting, accounting systems, and last but not the least, what is GST? So what we are waiting for? Let's start learning. Have you ever heard about GAAP? Well, GAAP means Generally Accepted Accounting Principles. It refers to the rules or guidelines adopted for recording and reporting of business transactions, in order to bring uniformity in the preparation and the presentation of financial statements. These rules or accounting principles are described by various terms such as assumptions, concepts, conventions, doctrines, postulates, etc. These principles or rules are derived from experience and practice, and when they prove useful, they become accepted as accounting principles. One of the main purpose of GAAP is to ensure some basic level of consistency in the accounting statement of all different organizations. It enables external users of the financial statements to easily interpret and understand the accounts of a company. GAAP will also allow intrafirm and interfirm comparisons, that is to see how a firm has performed as compared to the other firms, as well as to see how it has performed as compared to the previous years, which help these users make investment decisions. Another purpose of imposing GAAP is to ensure that the representation of the financial statement is true and fair. If GAAP rules are followed religiously, then there is a certain level of certainty in the fairness of the financial statements. These principles will ensure that the management is not manipulating accounts to suit their purposes. However, GAAP is not universal. The details and specifications of GAAP varies according to different geographic locations, industries, accounting body, etc. For example, in USA, GAAP rules have been modified by the Financial Accounting Standards Board. Similarly, many countries and accounting bodies modify the GAAP rules to suit their industries and economies. So now let's check out these accounting principles in detail. Accounting principles. As I mentioned before, these accounting principles are also referred to as concepts and conventions. The term concept refers to the necessary assumptions and ideas, which are fundamental to accounting practice, and the term conventions mean customs or traditions as a guide for the preparation and presentation of accounting statements. Practically, it is observed that these terms have been used interchangeably. Hence, to avoid any confusion, we are going to refer these principles as basic accounting concepts. Basic accounting concepts. Accounting is a business language. It speaks about business affairs. This business language must convey the same meaning everywhere. So, it has been developed around some commonly accepted ideas or assumptions. These fundamental ideas are called basic accounting concepts. These concepts guide how transactions should be recorded and reported. There are 13 accounting concepts that find wide acceptance across the world by accounting professionals. They are as follows. First is business entity concept. The concept of business entity suggests that business is an entity in itself. So business is separate from its owner. That's why the businessman should keep his expenses and income separate from the business firm expenses or income, unless it is related to business funds. Meaning, whenever businessmen invest in the business firm, it is recorded in a separate account known as capital account, and whenever businessmen withdraw from the business firm, it is recorded in a separate account known as drawings. However, businessmen's other household transactions which do not link to business firm is not considered. Second is money measurement concept. The concept of money measurement suggests that accounting records only those transactions or events which can be measured in terms of money. The transactions or events which are not measurable in terms of money cannot be recorded. Therefore, monetary transactions such as the sale of goods, payment for the expense, etc. are recorded in books of accounts. But non-monetary transactions such as the appointment of managers, capabilities of workers, image of an organization, etc. are not recorded in books of accounts. Third is going concern concept. The concept of going concern suggests that we should assume that the business will continue forever or it is a going concern. Therefore, we should create reserves for expected losses, such as depreciation and doubtful debt. For example, let's assume we purchase machine costing 50,000 and its service lifespan is 5 years. We can't charge the whole amount 50,000 from the revenue of the year in which the asset was purchased. Instead, we charge evenly in its lifespan. Hence 10,000 is charged for the period and the remaining amount is forwarded to the next year. Fourth is accounting period concept. The concept of accounting period suggests that accounting statements of an enterprise are prepared to know whether it has earned profits, or incurred losses during the accounting period, and what exactly is the position of its assets and liabilities, at the end of that period. Different users require such information at regular interval. Hence, the financial statements are prepared at regular intervals, normally after 1 year, so that timely information is available to the users. Fifth is cost concept. The concept of cost suggests that all assets should be recorded at the actual cost, which includes cost of purchase, transportation charges, and installation as well. Assets and transactions should never be overvalued or undervalued. This is necessary to make accounting reliable and accurate. For example, old machine is purchased for 5 lakhs, transportation charges for the machine are 5,000, besides 10,000 is spent on repair and 5,000 on its installation. Hence, the total amount recorded in the books of accounts for this machinery is 5,20,000. Sixth, dual aspect concept. The concept of dual aspect suggests that every transaction has a dual or twofold effect, and therefore recorded at 2 places. For example, Mr. B started a business with cash 50,000. Here, the business firm is receiving the benefit in form of cash and businessman is the giving this benefit, hence the first effect is an increase in asset, that is cash, and the second effect is an increase in owner's capital. Let's take another example. Suppose firms purchase goods worth of 10,000 for cash. This will again affect 2 accounts that are increasing in the asset, that is stock, as goods are coming into business, and decrease in another asset, that is cash, as we are paying money for the same. This dual aspect concept also expressed in terms of the fundamental accounting equation, which says asset equals capital plus liabilities. 7th is revenue recognition or realization concept. This concept suggests that revenue should be recorded only when it is realized or achieved. It should not anticipate incomes. Incomes or revenue should be taken in accounts only when it is realized or some party has accepted its liability to pay in future. In short, revenue is recognized when a sale is complete or service is rendered, rather when cash is received. For example, rent received for March 2019, even if it is received in April, it will be taken into the profit and loss account of the financial year ending March 31, 2019, and not into financial year beginning with April 2019. 8th is matching concept. The concept of matching suggests that while ascertaining profit or loss for the year, expenses incurred in an accounting period should be matched with the revenues during that accounting period. For example, expenses such as salaries, rent, insurance are recognized based on the period to which they relate or matched and not when these are paid. Similarly, costs like depreciation of a fixed asset are divided over the periods during which the asset is used. 9th is full disclosure concept. According to this guiding principle, all material and relevant facts concerning the financial performance of an enterprise must be fully and completely disclosed in the financial statements, of course along with their accompanying footnotes. This is to enable the users to make a correct assessment about the profitability and financial soundness of the enterprise, and help them to make informed decisions. 10th is consistency concept. According to this guiding principle, the business concern should follow uniform accounts for all years. Consistency of record helps in making the comparison between past and present business results. It also eliminates personal bias and helps in achieving comparable results. 11th is conservatism or prudence concept. According to this guiding principle, the accountant has to record the actual financial position while recording the accounts. Profits should not be recorded until it is realized, and all losses, even those which may have a remote possibility, are to be provided in the books of account. Therefore, an accountant should not give a different picture of the business, either by inflating or deleting the value of the transaction. 12th is materiality concept. According to this guiding principle, accounting should focus on material facts. Efforts should not be wasted in recording and presenting facts which are immaterial in determination of income. This principle is the exception of the full disclosure principle. According to the American Accounting Association, an item should regard as material if there is reason to believe that knowledge of it would influence the decision of the informed investor. For example, money spent on the creation of additional capacity of production would be a material fact, as it is going to increase the future earning capacity of the enterprise. Last but not the least, 13th is objectivity concept. According to this guiding principle, accounting transaction should be recorded objectively, free from the bias of accountants and others. This can be possible when verifiable documents or vouchers support each of the transaction. For example, the transaction for the purchase of materials may be supported by the cash receipt for the money paid or copy of invoice for the credit purchase. Well, now you know what accounting principles are. However, it can be implemented only by standardizing these principles. So, let's see how it is done. Accounting standards. Accounting standards provide frameworks and standardize accounting policies, so that the financial statements of different enterprises become comparable. The main intention is to make sure all companies and organizations follow the same rules for accounting and have the same format for their financial statements. These accounting standards are implemented in the whole country. So this means the entire national economy can implement the same standards and can adopt similar accounting terminology. Hence, all organizations and business units have a uniform, precise and correct financial statements and records. Accounting standards are written policy document issued by ICAI, that is Institute of Chartered Accountants of India, covering the aspects of recognition of events and transactions in the financial statements, measurements of these transactions and events, presentation of transactions and events in the financial statements, in a manner that is meaningful and understandable to the reader, and finally disclosing these transactions and events to enable the public at large, that is the stakeholder and the potential investors in general, to get an insight into what these financial statements are trying to reflect and facilitating them to make sensible and informed business decisions. These accounting standards are named as well as numbered, almost similar to the IFRS. They are based on and adapted from the GAAP, with some modifications necessary for the Indian economy. These standards solve conflicting accounting issues, detailing the accounting treatment, rules, and directives. They are detailed and informative so to avoid any confusion or uncertainty. In short, accounting standards aims at improving the quality of financial reporting by promoting comparability, consistency, and transparency, in the interest of users of financial statements, mainly for taking investment decisions. We need to learn all these principles, standards, etc., to provide reliable and comparable information to users of accounting. Don't forget that. Why? Because good financial reporting not only promotes a healthy financial market, but it also helps in the reduction of the cost of capital, as investors can have faith in financial reports and consequently perceive lesser risk. Now let's see the list of accounting standards issued by ICAI. List of accounting standards issued by ICAI. AS1 deals with disclosure of accounting policies. AS2 deals with valuation of inventories. AS3 deals with cash flow statements. AS4 deals with contingencies and events occurring after balance sheet date. AS5 deals with net profit or loss for the period, prior period items and changes in accounting policies. AS6 deals with depreciation accounting. AS7 deals with accounting for construction contracts. AS8 deals with accounting for research and development. AS9 deals with revenue recognition. AS10 deals with property, plant, and equipment. AS11 deals with the effects of changes in foreign exchange rates. AS12 deals with accounting for government grants. AS13 deals with accounting of investments. AS14 deals with accounting for amalgamation. AS15 deals with accounting for employees' benefits. AS16 deals with borrowing costs. AS17 deals with segment reporting. AS18 deals with related party disclosures. AS19 deals with lease accounting. AS20 deals with earnings per share. AS21 deals with consolidated financial statements. AS22 deals with accounting for taxes on income. AS23 deals with accounting for investments and associates in consolidated financial statements. AS24 deals with discontinuing operations. AS25 deals with interim financial statement. AS26 deals with intangible assets. AS27 deals with financial reporting of interest in joint ventures. AS28 deals with impairment of asset. AS29 deals with provisions, contingent liabilities, and contingent assets. AS30 deals with financial instruments, recognition and measurement. AS31 deals with financial instruments, presentation. And lastly, AS32 deals with financial instruments, disclosures. These 32 accounting standards issued by Institute of Chartered Accountants of India, out of which AS6, 8, 30, 31, and 32 are deleted, revised or being merged with other accounting standards, mainly due to global standards, as every country has their own accounting standards. So what are these global standards? Let's check out why IFRS is required as global standard. IFRS as global standard. Let's first see what we meant by IFRS. IFRS stands for International Financial Reporting Standards. It is an international framework for accounting records and financial statements. These are developed by the independent accounting body from London, known as the International Accounting Standard Board, IASB. As we know, many countries around the world follow their own versions of GAAP rules. The USA, Canada, Australia, UK, India all have their own GAAP rules for accounting suiting their economy. This lacks uniformity. Also, it creates a problem for multinational companies MNCs, which are having branches in many countries. Hence the IFRS was developed, so that all nations could adopt one global accounting standard. Why we need IFRS and how it will benefit. IFRS helps to prevent material manipulation or errors in financial statements. It helps in the global harmonization and promotes global standards for business growth. It also facilitates global investment. For uniform accounting policies and procedures, almost all countries, including India, have agreed to apply IFRS. But the name of this IFRS has been converged as Indian Accounting Standards. Practically, Indian accounting standards, that is INDAS, are not different from IFRS. INDAS is accounting standard notified by the Ministry of Corporate Affairs MCA, and has a wide range of convergence as compared to existing accounting standards issued by ICAI. So far, MCA has notified 42 INDAS. Okay, my dear students. Till now you have learned what is GAAP, basic accounting principles, accounting standards, as well as global standard IFRS. So far you have learned the principles and policies to be kept in mind while doing accounts. Now let's see the accounting approaches, that is basis of accounting. Basis of accounting. From the point of view of timing, for recognition of revenue and costs, there can be two broad approaches to accounting. These are: first is on cash basis, and second is on accrual basis. Under the cash basis, entries in the book of accounts are made when cash is received or paid, and not when the receipt or payment becomes due. For example, office rent for December 2019 is paid in January 2020, it would be recorded only in January 2020 and not in December 2019. Similarly, goods sold on credit in January 2020 would not be recorded in January but in the month when the payment is received. Thus this system is incompatible with the matching principle, which states that the revenue of a period is matched with the cost of the same period. Though it is simple, but this method is inappropriate for most organizations, as profit is calculated as a difference between the receipts and payment for the given period, rather than on happening of the transactions. Under the accrual basis, revenues and costs are recognized in the period in which they occur, rather when they are paid. A distinction is made between the receipt of cash and the right to receive cash, and payment of cash and legal obligation to pay cash. Thus, under this system, the monetary effect of a transaction is taken into account in the period in which they are earned rather than in the period in which cash is actually received or paid by the enterprise. This is a more appropriate basis for the calculation of profits, as expenses are matched against revenue earned for the same. For example, raw material consumed are matched against the cost of goods sold. Next, let's see what accounting systems are. Accounting systems. The systems of recording transactions in the book of accounts are generally classified into two types. They are single entry system and double entry system. Single entry system. This method of recording transaction is unscientific and incomplete. Some experts consider that it is not at all a system of accounting. Under this system, only one aspect of the transaction is recorded instead of two aspects. Hence this system is called a single entry system. Under this system, only cash account and personal account are maintained, ignoring real account and nominal accounts. Following are the limitations of single entry system. All transactions are not recorded. Only few accounts are maintained. Trial balance cannot be prepared at the end of the year to know the arithmetical accuracy. And final accounts cannot be prepared to find out operational results and financial position of the business. Double entry system. Under double entry system, the procedure of recording both receiving and giving aspects related to business transaction. This means for every debit or credit there will be a corresponding credit or debit respectively. Under this system, three accounts are maintained that are personal account, real account, and nominal account. Following are the advantages of double entry system. It records all transaction of the business. It gives correct and accurate information. It helps to check the arithmetic accuracy by preparing a trial balance. It helps in ascertainment of financial position of the business. It provides accounting information readily. It helps in preventing frauds as the recording of the transactions is based on vouchers. Okay, after learning basis of accounting and accounting systems, let's learn about the new concept recently introduced in India, as our last topic of this lesson. So lastly, let's learn what is meant by GST. What is GST? GST stands for Goods and Service Tax. It is based on one country, one tax concept. GST is a destination-based tax and charged at a single point at the time of consumption, that is the place of supply, of goods and services by the end consumer. So the ultimate tax burden will be on consumers like you and me. Mainly taxes are classified into two types: direct taxes and indirect taxes. First is direct taxes. Direct tax is the tax paid to the government directly by the person known as assessee. Income tax on income of a person, capital gains tax, corporate tax, securities transaction tax, etc. are examples of direct taxes. Second is indirect taxes. An indirect tax is a tax collected by an intermediary from the person or consumer, who bears the ultimate economic burden of the tax. India as a federal nation, both centre as well as state government, have the power to impose and collect taxes through appropriate legislation, as they both have individual responsibilities. Earlier centre government collects indirect taxes such as service tax, excise duty, CST, customs, etc. And state government collects separate indirect taxes such as VAT, entry, octroi, luxury tax, etc., which is now replaced by GST, goods and service tax. Hence, GST is an indirect tax. In India it came into effect from July 1, 2017. In India GST is called as a multi-tiered system because it currently has 4 slab rates, distributed evenly between central government and state government, that is 5%, 12%, 18% and 28%, unlike one tax rate in other countries. 5% GST is charged for mass consumption items such as edible oils, branded cereals, insulin, etc. 12% GST is charged for processed food items such as pasta, butter, and other fats, etc. 18% GST is charged for electronic items such as refrigerators, TV, smartphones, etc. And 28% GST is charged for luxury items such as luxury cars, AC, tobacco, aerated drinks, etc. Now let's see GST tax structure. There are 3 main components of GST, which are CGST, SGST, and IGST. To determine whether CGST, SGST, or IGST will be applicable in a taxable transaction, it is important that first you know if the transaction is intrastate supply or an interstate supply. The intrastate transaction means when the location of the supplier or seller, and the place of supply, that is the location of the buyer, are in the same state. Means buyer and seller are in same state and it is sale within the state. In intrastate transactions, a seller has to collect both CGST and SGST from the buyer. The CGST gets deposited with central government and SGST gets deposited with state government. First, let's see what is CGST. CGST means Central Goods and Services Tax. Taxes collected under CGST is the revenue for the central government. The present central taxes like central excise duty, additional excise duty, special excise duty, central sales tax, etc., will be included under CGST. Next, let's see what is SGST. SGST means State Good and Services Tax. Taxes collected under SGST is the revenue for the state government. With SGST, all state taxes like VAT, entertainment tax, luxury tax, entry tax, etc., will be merged. Let's see an example of these two components. Mr. A dealer in Punjab sell goods to Mr. B in Punjab worth 10,000. This is sale within the state. If the GST rate is 18%, that is 9% CGST and 9% SGST. The dealer will collect 900 CGST which will go to central government, and 900 SGST which will go to Punjab government. Interstate transaction. The interstate transaction means when the location of the supplier or seller, and the place of supply, that is the location of the buyer, are in different states. Means buyer is in one state, and seller is in another state, it is the sale made to another state. Also, in case of export or import of goods or services, or when the supply of goods or services is made by an SES unit, the transaction is assumed to be interstate. In an interstate transaction, a seller has to collect IGST from the buyer. Now let's see what is IGST. IGST means Integrated Goods and Services Tax. Revenue collected under IGST is divided between central and state government as per the rates specified by the government. IGST is charged on transfer of goods and services from one state to another. For example, Mr. A in Telangana sell goods to Mr. B in Mumbai worth 1 lakh. This is sale outside the state. And if GST rate is 18%, that is 9% CGST and 9% SGST. In this case, the dealer will charge a full 18% as IGST and 18,000 will go to the central government. Later central government will give the Mumbai state its share. Hence, if the sale is within the state, CGST and SGST is charged. And if the sale is made outside the state, only IGST is charged. That's it in this lesson. Thanks for watching. Go through with the lesson and test your knowledge with quiz in TYK section now. You can also find do-it-yourself workbook for your practice in DIY section. I will provide the link in the description box below. If you found this lesson useful, then like, share, comment and subscribe to Learn at Your Desk, because sharing knowledge means gaining knowledge. And don't forget to hit that bell icon to get notified when I upload new lesson. Stay tuned, learners. Coming up next, accounting terminology. Till then, take care and keep learning. Allah Hafiz.